Today, let's talk a little bit about disinterested directors for your nonprofit organization board of directors. Kind of a mouthful, but it's a very important sort of standard that you have to pay attention to for your IRS requirements to maintain and also for your application for your tax exemption. So, nonprofit organizations are required to have a board of directors. And in fact, the board of directors is the most closely related thing in a nonprofit to the owners. There is no owners of a nonprofit. That doesn't exist. There's no such thing as an owner of a nonprofit. There's no shares, so there's no ownership at all in a nonprofit. But the board of directors is essentially the stewards of the organization. They're the ones tasked with making the decisions and ensuring that those decisions are carried out by any officers or employees of that organization. If you wanted to say that there were any owners of a nonprofit organization, technically those are the beneficiaries of it. Those are the people that it serves because they're the ones that receive the benefit from what it does, like a shareholder would from a corporation. But I digress. So, the board of directors. A board of directors needs to have at least 51% or more disinterested directors. And so that means the majority of your board of directors. In a 3-person board, that's 2. In a 4-person board, you actually have to have 3 because you can't just have 2 because it has to be 51, not 50%. So 2 with 4 people, not enough. And you can see how that goes on. So 51% or more. And disinterested, what does that mean? I keep saying it. Disinterested means that they are not paid by the organization. So those board members are not receiving any type of financial payment for their board service. If they are also maybe the executive director or an employee of the organization and on the board, they're not receiving a salary or pay in those roles that they have with the organization, and or there's no other way that they're being compensated financially by the organization. That's one way that you would be interested, right? If you were receiving a payment, you're interested. So if you're not in any way, you are disinterested. But also, family members of anybody that is interested, anybody that is paid by the organization, those family members are considered interested as well. And so, to help this make more sense, obviously, if you're paid by the organization, you're very interested in the organization's finances and its success so that it continues to pay you. So, you have to have 51% or more, the majority of your board needs to be disinterested so that they're making decisions based on what's best for the beneficiaries, not what's based on what's best for them, because if they're disinterested, they don't care about getting paid and how the organization is doing from a financial, can it pay me standpoint. They just care, are the beneficiaries served? Are our programs doing what they're supposed to? Are we doing what we set out under our charitable purpose? And so you must have a majority disinterested directors so that they don't even have the chance of looking at controlling the organization for their own benefit, which, by the way, bonus, is called private inurement when a private individual benefits from a nonprofit organization, and especially when they have the ability to cause that benefit for themselves. So, 51% or more disinterested directors. You will need those numbers correct for your initial board meeting, which is required to file the nonprofit tax-exempt application to the IRS. 51% or more disinterested, not paid, not a family member of someone paid. Thanks. Have a good day.